Well, let's go to those unemployment numbers, the worst in 44 months. Just 2,000 jobs were created in June, compared with 34,000 people who lost jobs. So far, the Albanese government has managed to bring down inflation without the typical spike in the unemployment rate. Indeed, in the past 12 months, 280,000 jobs have been created, which the government is very proud of. But with the economy growing at less than 1% a year and the private sector struggling, this could well be the first sign of a tougher jobs market into the future. Now, let's hear from the Employment Minister, Amanda Rishworth, on deck today for the government. She went with the line that the employment problem isn't an Australian one, but is due to global factors.
What we have been focused on is making sure that we are navigating global uncertainty. There is significant global uncertainty across the world, and of course, that has an impact here in Australia. But I would say that the uptick in unemployment is broadly in line with Treasury's forecasts that were outlined in March.
That global uncertainty stuff, by the way, is of course bunkum, not right at all. Other things are at play here in Australia. So let's bring in the Chief Economist for Deutsche Bank in Australia, Phil Donahue, who joins me from our Sydney studio. Phil, many thanks for your time. It is true, this is about domestic factors. It's got nothing to do with international factors right now, has it?
Yeah, look, Ross, I really think this is a domestic story, this slowdown in the labour market. What has been surprising, perhaps, is how long it's taken to manifest. We know that non-market jobs have been very strong. We don't get that breakdown in these data that were out today, but, the economists, myself included, have been waiting to see some slowdown. We were surprised by that strength, and, these numbers, I think, very much reflect the tightening in monetary policy here domestically. In some sense, it's good news for the RBA since it's taking inflation out of the system. But, yeah, I really would... my sense is that this is very much a domestic story for us.
The interesting thing, and it's been quite deliberate in its strategy, the Reserve Bank has tried to get ahead of the curve in terms of trying to make certain monetary policies not reacting to things that happen in the economy. But you get a sense now that, given the fact it did not cut interest rates at its last meeting, that it may now be starting to be behind the curve and having to react to these tangible signs, like this unemployment rate in Australia's economy.
Yeah, look, it's always have to take some caution. We know that this monthly series can be pretty volatile. The RBA won't be panicking on the back of this one print. We have now seen, though, 2 months with basically no job growth. We saw the big pickup in unemployment today. So, a few eyebrows raised for sure. I was surprised last week when the RBA didn't cut rates, along with most economists and certainly with market pricing. I was expecting a rate cut, and indeed I still think that a rate cut would have been the appropriate course of action. We know that some board members were willing to cut rates last week. Some others were wanting to wait to see some confirmation in inflation data. But yes, as you say, perhaps had this meeting happened before, had this data come out before the meeting, we may have seen a different result. Not too sure about that. The RBA will look towards the CPI data, the quarterly CPI data that's out in a couple of weeks. That remains more important. But certainly for me, I'm pretty comfortable that we will get a rate cut at the next meeting. But that said, I should counsel that, I was pretty confident we'd get a rate cut last week, and I was wrong on that. So I do think there's scope for rate easing. Should be coming next month, but we'll see.
OK, so Phil, the important aspect here for jobs, people losing jobs, 34,000, is not a good thing for the economy. Now, it's still at an historic low rate, our unemployment rate. But the issue is that the quarterly growth for our economy was just 0.2%. So annualised, that's below 1%. The long-term average is 3%. The real issue here is the private sector. The private sector has no confidence, it's not employing, it's not investing. And that is fundamentally a problem for government right now.
Yeah, look, we know, you're right. The private sector has been weak. Growth is well below trend. Household consumption in per capita terms is as weak today as it was in the early 1990s recession. What has been holding up the broader GDP, the broader activity statistics, is public spending. And that certainly has been, we've been seeing that in the labour market as well. But this is certainly an economy that is growing below trend. We can see, and I expect to see, a pickup in growth. Again, you're right. This below trend is something to wring our hands around. but it has been by design. We had an inflation problem. The RBA had to respond to that, and they have done so. So we needed to have a period of weakness. My sense is that inflation problem that we were facing a couple of years ago is pretty much in the rearview mirror now. The focus, I think, for the RBA the next year, the next 18 months, should be about getting back to trend growth. That, in the long run, will be supportive for the labour market, will keep the unemployment rate at or near historical lows. So that's the next challenge for the RBA. And it means, in terms of policy, it means rate cuts, I think, will be necessary.
Yeah, well, rate cuts are necessary, but it takes more than maybe one or two to start to stimulate the business sector, to start to get new buildings going, to start to get infrastructure and investment going into Australia. And let's be honest, many businesses are also worried about energy prices in this country right now.
Yeah, look, I expect 3 cuts by the end of this year. My spreadsheet, for better or worse, is looking for 3 more cuts. We've already had 2. We've seen 50 basis points of easing. I'm expecting the cash rate to get down to 3.1% by the end of this year. And I'm certainly telling my clients that next year the risk is we see even more. Again, this was an economy that pre-COVID, we had a cash rate than 1%. So I think we can see more easing, certainly this year, possibly even next year.
That's fantastic. Phil O'Donoghue from Deutsche Bank. Always great to chat to you. Many thanks for your time today.